Swayam Prabha. Digital India. Educated India.
We are coming to the end of topic 1, what is money. We started out with a definition of money, what money is, how it can be an effective medium of exchange. When talk about historical development of money, coins, paper currency, then banking, checking accounts, etc. Then went to modern money which you use, you will have lots of them. Then I went into a discussion of interest rate. Interest rate is kind of considered to be the price of money, because what money has a price? A currency है मेरे pocket में, price क्या है? So usually we think about interest rate, but the problem is there are so many kinds of interest rates in the economy, so many kinds of interest rates. So we need to discuss interest rates, and I have been doing that. Then I came to present discounted value, which requires an interest rate as a discount factor. So something will happen in future. I will get some income from a share in future. I will get some income from a bond in future. Whether I should put money in the bond, how to decide? So I went into the secondary market also, the price of a bond. In the primary market also there is a price. And I told you how a very special type of interest rate that develops as a variable in an economy with respect to these debt instruments called yield to maturity, which is essentially a variable as an unknown in an equation which is a polynomial. If you solve, you get the number, which equates the price today of a debt instrument, which equates the price with to the present discounted value of the series of return that I will get if I buy it. So if I buy a bond or invest money in a bond using your language, is it worth investing? What kind of a return do I get? There you get the concept of yield to maturity, which I told you, which is also an interest rate. So you get into the concept of yield to maturity, and yield to maturity is like solving an equation that gives you yield to maturity. Now let me ask you a simple question. Now suppose I give you a problem like an arithmetical problem. Say I buy a discount bond, which are zero coupon bonds. I buy a discount bond which is sold at a discount, and it lasts only one period. It's a very short term bond. So I buy the bond. Suppose I buy the bond, a discount bond, at I buy a discount bond at price P, right? Then after one period I get the face value of the bond back, say 100 rupees. Take after one period bond. What is the yield to maturity? Somebody asks you, what is YTM? How would you get the YTM? What I taught you so far, I am asking you to solve a simple problem. I buy a bond at P, F is the face value we get after one period. F minus F by P minus 1. Very good. That is the yield to maturity. So it is F minus P over P. It's very simple to calculate. Now I get into something which is, I am coming to the end of topic 1. I get into something, I do not want to get angry, but sometimes I feel angry. Now, I get into coming to the end. There is a concept of something called a return on a debt instrument like a bond, a return on a debt instrument. There is a concept called return on a debt instrument. Now, how to calculate that? Return on a debt instrument. Return on a debt instrument. Now, this is looked at from the point of view of an investor. Tomorrow, you buy a certificate, a bond certificate. It can also be true with respect to, you can calculate similar things with respect to a share. Tomorrow, you invest some money, bond certificate which clearly says, a coupon bond which says how much it pays you every year, the coupon rate, what's the face value of it. It says all those things, and it talks about the maturity, say a 10-year bond or something, a 5-year bond, 10-year bond. But after 1 year, you hold it after 1 year suppose, and you want to sell it off. Now, the question may arise, after 1 year he wants to sell it off. So, what kind of a return does he get? Of course, he will get the coupon payment. Suppose 1000 rupee bond, 10% is the interest rate. So, he will get the coupon payment after 1 year, say for the government bond. So, I get it from the government. And then, when he is selling it off, often the incentive is the demand for this kind of an instrument has gone up so much in 1 year, that the market price at which it is being sold presently, the secondary market price, is higher than the price at which he bought. So, this is the incentive for him to sell it off and not wait for 10 years to get all the return. So, the return on bond, this I found in Mishkin, the return on bond is as follows. The return on bond is as follows. Suppose consider a coupon bond. Now, there is a face value of the bond. Okay. There is a market price of the bond, now considered to be 2 time periods, PT and PT plus 1, or I bought it at PT minus 1, I am selling it at PT, whatever, 2 time periods. There is a coupon value of the bond depending upon the coupon rate, which is the interest rate that it promises, 10% or whatever. So, the return on bond is calculated as, let us see whether it makes sense to you, the coupon value plus the difference in the price at which you bought the bond divided by PT with respect to the price that you bought. This is defined as the coupon, the rate of return on the bond, which is essentially C over PT plus PT plus 1 minus PT divided by PT. This is what it works out to be, R. Okay? Now, no big deal here, but there are technical names associated with it, which I am trying to tell you a few names, which terminologies. The terminologies are that this return on that bond after 1 year when I am selling it off I got the coupon payment for 1 year C, 1C. C over PT, C over PT is called current yield. And PT plus 1 minus PT over PT is called capital gain. But whenever we talk about capital gain, we also mention with a slash there can also be capital loss. Not necessarily it will be a gain. Suppose the market is going down and you are trying to minimize the loss. Market is going down, prices are falling. You want to sell it off as quickly as possible. Even if there is a loss, no capital gain or zero capital gain or loss, negative number there, PT plus 1 minus PT over PT, negative number. I am going to go for a minimization of loss. Return may still be positive because the coupon payment is good, but the capital gain term has been replaced by a capital loss. PT plus 1 minus PT over PT is negative. So, this fellow here can be greater than, equal to, less than 0. Remember that. It is always a possibility.
So, what is the logic when inclusion of PT plus 1 minus PT calculating the rate of return?
That is the rate of return, that is the logic.
So, because a person, if he gets the bond to the coupon bond to the person who has issued it.
No, no, no. He doesn't rebuy, he repurchase it. He has sold it for 10 years.
Like after maturity period.
After maturity period ka baat nahi kar raha hu. After 1 year, he is selling it off. I don't want to hold it anymore. I am going to the secondary market. That is why all he gets is 1 period return, depending upon the coupon rate. The bond promises to pay an interest rate of 10%, say. He gets the 10% income C, and which is time invariant because C is a constant, and every period he will get C. If he holds for 10 years, 10-year long bond, he holds for 10 years, every year he gets C. At the 10th year, after the 10th year, he gets the face value back. And now if he sells it, there is an additional return. The return is the capital gain. This is what he gambles, essentially. And he finds if the capital gain is good, prices have gone up sufficiently, it can happen after 1 year, it can happen after 2 years, it can happen after 3 years, who knows. And he offloads that bond in the secondary market, and not only earns a coupon payment from the issuer of the bond, say the government, but also when he offloads, he gets a capital gain. But it can so happen, he offloads not to make a gain, but to minimize loss, remember. Because if the market is falling, he just wants to go into something else, he does not want to hold on to the bond anymore, he would minimize the loss. Although the return R can be positive, the capital gain, the capital loss is small compared to C over current yield, C over PT. You will find that in Michigan. There are many such relationships that can develop with respect to an instrument. I am just mentioning a few: interest rate, yield to maturity, present discounted value. Now I am talking about return on a bond. Now, finally, I have already spoken about it. I have already spoken about it. That is called the interest rate. The interest rates are of two types in an economy. The nominal interest rate is the one you see, and the real interest rate is the one which you can calculate. Nominal interest rate minus inflation rate is the real interest rate, and I told you in one class, one of these lectures, that it can so happen that the real interest rate can be negative, because nominal interest rate I is equal to real interest rate R plus pi. If pi is too high, say pi is 10%, and I is 7%. So, the real interest rate is minus 3%. Real interest rate can be negative in an economy, it is possible, which is in some sense also return on an investor. I put money in the bank, fixed deposit. What do I get? I get the nominal interest payment. But if the inflation rate is higher than the interest rate, my real return, that is also a measure of return. The real return is, which is more popular in macroeconomics than monetary economics or financial economics. The real return is negative. Actually, I lost money by putting money in the bank. So, at times of high inflation, often if the interest rates are not high, people prefer to spend it, because if you accumulate goods, it may not lose that amount of value. When the economy revives, I can sell off the goods. Say people buy property, because they know that there is a slump, maybe prices are low, so buy them instead of putting money in the bank or a bond market or something, put it in a property or jewelry or gold, whose price they expect to appreciate again when the economy is revived, and that is how they gamble. That is why what you have is a wealth, a basket of items. People have to decide where to put the money, which you understand intuitively quite well, I think. It's nothing, there is no extra message that an economist can give you or an economics profession can give you. I am just giving you some technical things here. Now, the problem, as I told you, that the real return or real interest rate can become negative creates a problem. These bonds have promised an interest rate. Now, if the inflation is going up and I am going to hold a bond for 10 years, because it has a maturity period of 10 years, length of the time of the bond to mature is 10 years, my return can become negative. So, many countries have now developed something called indexed bonds. This is the language you have to learn, indexed bonds. This is indexed to the inflation rate. That is, if the inflation goes up too much beyond a critical value, then the issuer of the bond announces that that interest rate will become not 10% anymore, but say 11% or 10.5% or 12%. So that the time you get the return, you do not lose value in real terms. You have a real income. Real rate in some sense does not become negative. All right. Even here, R has a possibility of becoming negative, you can see that, or 0. Who has stopped you? If you allow even C over P, even if you say C over P can never be negative, even if you say C over P that is always positive, even if you say C over P is always positive, but this fellow here can create hell for you. When the stock market is crashing, for instance, can create hell for you. So, that R is not a nice thing that you come home with. You lose money from the stock market or the bond market or whatever. All right? Okay. Clear? Please read Mishkin. It is an intuitive expression. They use that to calculate return. How do you come up with nominal interest rate is equal to real interest rate plus pi? There is some logic that you use to develop that relationship. It is not algebraically obtained from something. Economics is largely based on intuition. It is a very intuitive subject. Now, is that all right? So, there I have given you an introduction to money and price of money and very important things I have touched upon: yield to maturity, interest rates, return on papers, bonds, etc., various kinds of bonds, console, discount bond, zero coupon bond, coupon bond. Coupon bonds are they are very common, treasury bills, etc. I have told that some treasury bills are also zero coupon bond, console. Then you have these various kinds of loans that you can, fixed payment loan, which is very common, you pay EMI. You talk to anybody taking a loan from a bank to buy a car or purchase a house, they will tell you about the EMI thing. EMI is a fixed payment loan. It's very simple. It's not you pay the interest every month and only the principal at the end. The entire amount for the entire span of the loan, 10-year loan, is divided into 12 equal parts by the bank. They calculate it. And say 10 equal parts. And every part then they subdivide into monthly basis by dividing it by 12. And then they give you an EMI. The problem is, banks are very smart. They make that EMI of an index to inflation. But when you buy a fixed deposit certificate from a bank, interest rate is not indexed to inflation. I haven't seen that, at least with Indian banks. But the EMI is an index to inflation. Suddenly a paper comes to your home. You come home from office. You know this is the EMI you pay. You budget your family expenses. 2000 रुपया ज़्यादा अगले महीने से. ये डरने के, this creates a scare among borrowers, middle income group borrowers. There have been many interesting cases, criminal cases and all sorts of things. Then he fails to pay the EMI. On a simple scooter or a motorcycle, a person took loan in Delhi a few years back. He failed to pay the EMI, and ICICI Bank sent their musclemen to recover the money. And then they drive him up the wall, and then he commits suicide on a simple motorcycle loan. How do banks recover? They can go to court, and they are finding court proceedings very lengthy, so they send musclemen. They hire these muscle people, maybe wrestlers from Accra or something. तो ओलंपिक में भेजना तो बाद में होगा, अभी मेरा रुपया उसके पास से ले आओ, बाद में ओलंपिक में भेज दूंगा, ये कॉमनवेल्थ गेम्स होगा. I am not joking at all. This is true with Indian banks, the famous ones also, ICICI. Achha. I read in the newspaper, on the TV, my source of knowledge, unless they are lying. I don't know. I never met these families. Achha. So now I go to topic 2. Topic 2. Now I am getting into core of money and banking. This was an introductory part. Initially I called that the money supply process, because money supply is a process, but I dropped the word process because it bothers people probably. You can call that money supply. Now I am going to define money supply, which you have seen in ISLM models as M. Now what that M is, I am going to talk about that M. So this is topic 2. Now money supply, which we call in macroeconomics money supply, in monetary economics this is often referred to as, there are various kinds of definition of money supply. So they refer to that as a monetary aggregate. They call that a monetary aggregate. Aggregate is what? When you sum up, add things. So when I will now give you the definition of money supply, you will see there is an arithmetical sum going on, and you change items, you get another monetary aggregate, another definition of money supply. You drop something, add something else, you get another one, or you add a few more items, arithmetical sum, you get another monetary aggregate, which is another definition of money supply. Now traditionally Indian monetary aggregates, that is what I need to talk about first. Traditional Indian monetary aggregates. Traditional Indian monetary aggregates. Before I talk about the traditional Indian monetary aggregates, I need to talk about one very important, which is also a monetary aggregate, but is not considered to be money supply. It is also an aggregate. It adds up a few things. Item A, item B, item C, item D are added and you get that. This is not what is part of a traditional money supply in any country, but it exists in every country. This is like, you look at this building, it has a foundation. You dig into the earth and you have these concrete platforms created on which this building is erected. So, every structure that you see like a building has a base, not the floor I am talking about, floor which you can see, but the base you do not see. Base is underneath that floor on which the superstructure is built. So, every monetary aggregate or money supply, which we know as money supply, is actually built on this one base, and this is called, so I need to talk about that first. This is called monetary base. It is called monetary base. The base I use the word, it is also called monetary base. So, I need to define the base first, and it has other names also, or reserve money. Some books use the word reserve money, or base money, or high powered money. High powered money. So many names are there. I define this money or indicate this money wherever you will see me, and I have seen that in books also. Either they use the term, sometimes the notation they use either R, or since monetary aggregate is kind of a monetary aggregate, though not called money supply, because it adds up things, which is the base. They use the notation M naught. So, in most places it is M naught. I am going to use M naught. Some places they use the initial, which is very acceptable, like R. You know, Y stands for output or income, M stands for money supply, I or R stands for interest rate, capital I is investment, G is government expense. These are known things, notations in macroeconomics or economics. Pi for profit, C for cost, W for wage. This is very standard. So, I am giving you a notation which I would use is M naught, and the money supply I would use M definitions, M1, M2, M3, M4, etc. Now, what is reserve or base money? Consists of 3 items, M naught. M naught is equal to number 1 called currency in circulation. So, currency that is circulating, money in your pocket, in your hostel room, in your parents' almirah, cash. But it has two parts, currency in circulation. One is called, it has 2 parts. One is called currency with the public, plus cash with banks. Two parts are there. So, this is number 1, first item. Then you have, I would explain what are they, plus you have bankers' deposits with the RBI. Item number 2, bankers deposits with the RBI, Reserve Bank of India. Then it has the third item, which is not very clear to me, are other deposits with the RBI. Other deposits with RBI. So, this is the third item. So, essentially you add them up, 3 items. So, it is a monetary aggregate, but it is not called money supply. Money supply is very different. Money supply is something related to this. Now, I would explain these items, these reserve money items, monetary base items. Currency in circulation, usually central bank in India and in other countries they may also do the same thing. They consider currency that is there with the people, the public, and what is public I need to explain. What is currency first of all? You know, notes and coins. Currency is notes and coins, very simple. Public is much more complex, the definition. Public includes the entire economy except government, the central bank, and the entire banking system, which consists of commercial banks in India, cooperative banks, and at the head is the central bank, which I already mentioned. Public does not include government treasuries, where they keep cash for government use, whatever use, paying the salary maybe, paying whatever, or other kind of expenses, whatever. Public does not include the entire banking system, including the commercial banks like the State Bank of India and the Canara Bank and the Punjab National Bank and the Sindh Bank, then the Bank of Maharashtra, and then you go on at Bank of Baroda, United Bank of India, United Commercial Bank, whatever. It used to be about 28 and the number has come down, 28 public sector banks in India which are nationalized by the government. But in addition to the public sector banks, including 7 subsidiaries of SBI, SBI has subsidiaries also. Add also private banks, and it can all private banks, either Indian private banks or foreign private banks. So Citibank, Hong Kong Bank, Deutsche Bank, जितना कमर्शियल बैंक है जिधर में आप मैं जाके अकाउंट खोल सकता हूँ, रेमिटेंस के लिए ड्राफ्ट भेज सकता हूँ, all that. The entire banking system, but we also have cooperative banks which doesn't exist in other countries. I need to talk about that at the end of the course. Cooperative banks, the age old, early 20th century they were founded, cooperative banks in India, very interesting. So I would exclude that. So I will talk about that later. So the entire banking system, commercial banks like the SBI, etc., the cooperative banks, and the boss, central bank, RBI, excluded. Interestingly enough, there are some non-government government departments which deal with cash on a day-to-day basis, which are not really part of the government ministry, like government companies are there. You have seen many government companies, Indian Airlines, Air India. ठीक है? The currency lying with them is part of public, but not the traditional government treasuries, which Ministry of Finance has, for instance. That's the headquarter of money in government. Government treasuries are not part of public, like the banking system is not a part of public. Remember. So you would ask me, sir, non-banks, there are lots of non-banks. You just mentioned ICICI. It has also a commercial bank, ICICI Bank it's called. But I'm talking about the mother organization, ICICI. It's a non-bank. IDBI, SIDBI, you name it. There are so many. NABARD, non-banks. So many non-banks are there in India. State financial corporations, infrastructure development bank. What will happen to the non-banks? They are all part of public. Public includes them. Only basically two things are excluded: government treasuries and the banking system are excluded. Remember, public, that's the definition. Since banking system is excluded, currency in circulation has just not currency with the public plus cash with banks. Banks keep cash, no? For your and my withdrawal, for their expenses, they keep cash. For instant teller machines, they have no automatic teller machines, they also have to keep cash there. At the end of the day, they do that probably, or maybe twice a day they do that. They have a routine to do that, put cash there. So banks carry cash. Beg your pardon, beg your pardon. This is, I am talking about currency. This is, I am talking about currency only. There is nothing else, no goods there, no gold, no ornament, nothing. Currency means, in some sense, cash, what we call. We have two types of currency in India, notes and coins. That's all. There shouldn't be any confusion about it. Yes. Indian Railways will be part of the public, the cash they handle. It's like a government department. It has a Ministry of Railway, of course, but the cash it handles is not part of the Government of India Exchequer. Government of India Exchequer would be lying with the Finance Ministry, both at the state level, is their department. So, Indian Railway, after it earns, can contribute to the Exchequer. When it goes to the Exchequer, it is not part of. But so long cash is lying with Indian Airlines or Air India or Railways, they are like government companies in some sense. That is part of public. When I was young, just now the railways, airlines was also monopolized in India. India never had a private airlines. Foreign private airlines or national airlines, flights used to come. I remember my friends used to go abroad for studies, would travel by foreign airlines because often they would offer cheap rates to the students. So, they will pick up a bundle of students from Southeast Asia somewhere. They stop in India somewhere, Delhi, Calcutta, Bombay, anywhere. They pick up again another bundle of students, they are going to US maybe. Then they give them a halt, maybe European Airlines, some give them a halt 3-4 hours in Europe somewhere, and then put them again on another flight across Atlantic to US. It used to be a regular affair. Not everybody. Air India used to be very expensive, and they are so competitive, their prices were low, so the students would go take those flights. Thai Airlines, they had a tie-up with SAS, Scandinavian Air Service, I remember. So, they used to start in Bangkok somewhere, first stop, original. Then they would stop in Calcutta or Bombay or Delhi, go to maybe Pakistan in Karachi and straight to Europe, then cross the Atlantic. But no private Indian Airlines. India में Indian Airlines, Air India, अच्छा लगे या ना लगे. In fact, those days the service used to be better. I don't know what has happened with it. Service used to be quite good, but it used to be expensive a little bit compared to these foreign airlines. Anyway, that's a different thing. Now, bankers' deposits with the RBI, this is a very important item number 2. Let me conclude these 3 monetary base, and then I will come back day after tomorrow and talk about proper money supply definitions in India. 4 are very popular. So, I will talk about the 4, and you can access data. In fact, I will show you some data. You can access data also to the with respect to these 4 variables. Now, bankers' deposits are very compulsory in India. There is one very compulsory aspect of banking deposits is after the Great Depression in the Western world, 1929 to 1933, when banks failed, lots of banks failed, they decided to put a regulation, a regulatory measure from the central bank on all commercial banks that you have to deposit a percentage of the deposits that you mobilize with us. This is known as cash reserve ratio, CRR. Now, large chunk of bankers' deposit with RBI is the CRR money of commercial banks that lie with the RBI. Okay? So, a large chunk of that bankers' deposits with the RBI, there can be more cash, there can be more cash too, is called CRR, cash reserve ratio. This developed after the Great Depression of the 1930s. It wasn't there before. Funny thing is, you know, this time when the financial crisis came in the Western world, I was teaching money and banking course on the 6th floor. And I said, you won't believe me, this financial crisis wouldn't have happened and banks wouldn't have been in trouble if they had listened to their own rules which they set 40, 60 years back. They have now made in those countries CRR value 0. But India is a very traditional, conservative country. It is following CRR. And Indian banks never got into any trouble. Lots of cash always lies with the RBI. Those guys, those countries who invented CRR do not follow CRR. When I opened some books, when I first found in one book that the CRR value in Bank of Canada is nearly 0, I couldn't believe this. I said, this is nonsense. Then I found, yes, it's true. They don't have CRR. Cash reserve ratio, which is called CRR, is a very important thing. The deposits they mobilize to the savings account and the fixed deposits, etc., the money that goes from the public to the banks, a percentage on a weekly basis have to be kept, cash, not shown, kept with RBI. It will lie with RBI. And they give the banks these days for CRR a fortnight. So within a fortnight, 2 weeks back, the weekend, the cash you had, deposits, you give us the number and then deposit that amount. The depositing of that actual cash, they give banks a fortnight time, 15 days. This is how it is working now, CRR. I will talk about in topic 4, all these things. So, CRR, cash reserve ratio, is the main contributor to that bankers' deposits with RBI, but banks also keep their own money there. Banks also keep money. You know why? Because they have a centralized checking facilities now, clearing facilities, check clearing facilities. आपका बैंक में पेमेंट हुआ जो उनके बैंक में मिलना है किसी को, all right, it is done through RBI very easily because RBI has accounts of all banks. तो स्टेट बैंक में कोई चेक जमा किया जो बैंक ऑफ बड़ौदा का चेक है, स्टेट बैंक अकाउंट से रुपया लेके बैंक ऑफ बड़ौदा में डाल दो. Centralized clearing facility. I am like the main central room sitting with a person like an account, a person representing an account of one particular bank, not particular branch, a bank. So what the good thing is that the check did not have to go through postal service or manually from his to him and the cash to be carried. It's simply centralized. It's done here. I just debit this account, I credit this account. So what the centralized clearing facility, banks are required to keep accounts and cash also with RBI. What I have understood, I have never worked for RBI. If you work for RBI, no more. What I have understood by looking at the very minimal literature that is available, this is what they are doing. The references I have given you are also my references. I have no extra new reference to give to you in the course outline that I have given you. I haven't read anything extra. I haven't found anything extra relevant, significant yet. So all my knowledge is based on, without working in a bank, without working in RBI, looking up the material, opening the RBI site which is available online, and whatever I could understand. Yeah. So that's the banker's deposit. Now the other deposits, this is a very little amount, less than 1% even of monetary base, other deposits. I've looked at the numbers. I think other deposits consists of mainly foreign central banks, foreign banks deposits with RBI. They are allowed to open accounts. RBI is a central bank. I and you as public cannot open account there. But they give respect and give the freedom to a government, to a foreign government, to an international organization, maybe IMF, World Bank, Asian Development Bank, whatever, or a foreign central bank to open an account. But this money is very little compared to the total money, because the value I have seen is less than 1%. So, in my diagram, the slides I will show you on the variables, you will see other deposits line is coincide with the x-axis. It does not come above the x-axis, it is always sleeping there. It loves the bed, the x-axis bed. It never came up because it is insignificant. Over time, over year, it does not go up at all as a percentage. Even the absolute value is little, so little. Even the absolute value compared to the magnitude of bankers' deposits with RBI and currency in circulation, all right, is so little, it does not show. But I need to tell you about it, the importance. So, I will come up with slides at the end of the topic, many important slides and data. Unfortunately, in my course like this, applied course, I have to show you slides. Theory course, I do not show slides, but in applied course, I do. So, that is it for today.